It's pretty staggering when you think about it. France, as a nation-state, defaulted on its external debt 8 times. 8 times. And Spain, 13 defaults before what, 1800?
That's right, 13.
13.
Mm.
It just shows this isn't exactly a new problem, is it? So for you, our listener, we really want to unpack this today.
Yeah.
This deep dive, it's not about, predicting the next crisis, but more about giving you a clearer lens on these patterns, the ones that just keep cropping up in financial history.
Exactly. And what's really fascinating, what we're digging into for you, is understanding why these themes recur. We're leaning heavily on the book, This Time is Different, 8 Centuries of Financial Folly.
Great resource.
It is. Think of this as us sort of curating the key lessons, highlighting those moments of, financial missteps from the past, so maybe you can spot the echoes today.
Right.
Our aim isn't to, drown you in 8 centuries of data points.
No, definitely not.
But to pull out the really vital insights about why crises happen, and crucially, why that feeling of, but this time is different, can be so, treacherous.
Absolutely. We've sifted through a lot of history in this book to find what's most useful for you. So, okay, financial crises. Where do we even start trying to get a handle on something that seems so sprawling?
Well, the book does a good job setting up a framework, which is helpful. They break crises down into different types. Okay. You've got inflation crises. They define that as annual inflation hitting over 40%. Pretty high.
40%? Wow.
And currency crashes. That's when a country's currency drops more than 15% in value over a year. Uh-huh. Banking crises are treated more as specific events. Think bank runs, major failures, government bailouts, that sort of thing.
Right, the classic images.
And then sovereign defaults. And this is important. They look at both external debt, what's owed to foreigners, and domestic debt.
Okay, hold on. Domestic debt defaults. Now, that's interesting because I think for most people, maybe for you listening too, when you hear government default, you automatically think about Argentina not paying international bondholders or something.
That's exactly right. And the book makes a really big point about this, something that hasn't always been front and center in these discussions. They really stress that defaults on domestic debt. So money the government owes to its own citizens, its own banks, usually in its own currency. Well, that's been largely ignored by a lot of academics, policymakers.
Ignored why?
Well, we'll get into that. But they argue it's a massive blind spot in how we understand financial vulnerability.
So you're saying it's not just, the usual suspects, the emerging markets, that have a history of governments stiffing their creditors.
Precisely. The book just hammers this home. Sovereign default is way more universal than we tend to think. We mentioned France and Spain, major European powers with multiple defaults early on. And then you look at places like Greece or Austria. Their histories, from the early 1800s way into the post-World War II period, are practically defined by almost continuous default episodes.
Near continuous. That really changes the perspective, doesn't it? So for you listening, this relatively recent period where most governments have been filling their debts, that's actually the historical anomaly.
That's the argument, yes. This era of relative governmental creditworthiness is, historically speaking, quite unusual, which kind of brings us back to that domestic debt piece and why it's been so under the radar.
Okay, so let's dig into that. Why has domestic debt been overlooked, and why should you, listening now, care about it?
Well, the book points to a couple of things. First, just getting good, consistent historical data on government debt generally is surprisingly hard.
Really? Even now?
Even now, but especially going back centuries. And data on domestic debt, even tougher. There's often a lack of transparency, and, maybe that's not always accidental when governments are in a tight spot.
Convenient.
Could be. Second, there's been this sort of prevailing assumption in a lot of economic thinking that governments will almost always honor their domestic debts. Or if they don't want to pay full value, they'll just, inflate it away. Let inflation erode the real burden over time rather than overtly defaulting.
Ah, the inflation tax. But the book says that's not the whole story?
Not at all. They dug deep and found over 70 clear instances of governments explicitly defaulting on their domestic debt since 1800.
70.
Explicitly.
Yes. We're not just talking high inflation here. We're talking about governments forcibly changing loan terms, lowering interest rates retroactively, sometimes even just reducing the principal amount owed to their own citizens.
Wow.
And here's the kicker for you. These domestic defaults often happen during periods of even worse economic conditions than external defaults. Think bigger collapses in output, even higher inflation surrounding them. That's a critical difference. So, You really need to look at how governments treat their own people financially, not just foreign lenders.
Okay, what about banking crises? How do they approach defining those?
Right, so for banking, because getting consistent quantitative data across centuries and countries is really tricky.
Yeah, I can imagine.
They take more of an event-based approach. They identify periods with systemic bank runs, widespread failures, or big government interventions needed to keep the system afloat.
Okay.
And they talk about the classic vulnerability banks have what economists call maturity transformation.
Maturity transformation.
Yeah, basically, banks take in short-term deposits money you and I can pull out pretty much any time, but they make longer-term loans like mortgages or business loans.
Yeah, that mismatch.
Exactly. That mismatch makes them inherently vulnerable if confidence suddenly evaporates. If everyone rushes for the exits at once, bang, a bank run. Even if it starts with just rumors.
Yeah, you see it old movies, right? The panic, the lines outside the bank. It's based on something very real. Totally. And the book makes this really neat parallel for you. They point out that governments, especially those relying heavily on borrowing from outside the country, can face a similar dynamic.
If so.
If foreign investors suddenly lose confidence in a government's finances, they might just stop lending. They stop buying new bonds, refuse to roll over short-term debt, and that can trigger a sovereign debt crisis really fast. It's all about confidence.
It really is all connected, isn't it? Debt, banks, confidence. It's like a fragile ecosystem. And I know the book spends a lot of time on this mindset, this dangerous phrase. This time is different. Tell us about that.
Oh, yes. The this time is different syndrome. It's this incredibly powerful and recurring belief. The belief that this boom, this period of rising asset prices, often fueled by lots and lots of debt, is somehow fundamentally different from all the booms that came before it and ended badly.
You hear it all the time, don't you? Oh, the internet changes everything. Or financial innovation makes us safer now.
Exactly. We have better policies, productivity is higher, there's always a rationale.
Right.
But the core message of the book, what they show you through centuries of data, is that history may not repeat exactly, but it sure does rhyme. Pinpointing the exact moment a debt crisis will hit, that's notoriously difficult. Confidence is fickle, you know. Sometimes countries can sustain high debt for longer than seems possible.
So it's not perfectly predictable.
No. But the underlying principle holds. When countries get deeply indebted, when you see these massive asset bubbles fueled by borrowing, trouble eventually follows. The trigger might be unexpected, but the downturn, they argue, is almost inevitable.
So it's not just about the long-term drag of debt that some economic theories focus on, like the burden on future taxpayers.
That's part of it, sure. But the book really emphasizes the instability created by high debt in the shorter to medium term. It's the risk of that sudden loss of confidence that run on the country's credit that can spark a crisis much faster than people expect.
Looking back across those 8 centuries, did these crises tend to pop up randomly, or did they, cluster together?
Oh, definitely clusters. The book shows clear periods where defaults spiked.
Like when?
Well, you see peaks during the Napoleonic Wars, obviously a time of huge upheaval. Then again in the 1820s through the 1840s, tied off into independence movements and new borrowings. The Great Depression in the 1930s was a huge wave.
Of course.
And then more recently, the emerging market debt crises of the 1980s and 1990s. They also find a strong link between banking crises and sovereign external debt defaults. They often rise together, like during World War I, the Depression, and those 80s, 90s crises again.
It's like one thing triggers another, a domino effect.
Yeah.
You mentioned severe consequences. Is there a specific historical case that really illustrates just how bad things can get?
Well, the case of Newfoundland in the early 1930s is pretty extraordinary. It's a stark lesson for you.
Newfoundland. What happened?
They were facing this absolutely crushing debt burden. Their debt relative to government revenue had basically doubled, and just paying the interest was becoming impossible.
So what did they do? Default?
They went a step further. To avoid outright default, in 1933, they actually gave up their status as a self-governing dominion and essentially handed control back to the UK.
They gave up sovereignty.
Yes. To manage the debt crisis. It's an extreme example, but it shows the potential severity when debt gets completely out of hand.
Wow, that's dramatic. Okay, the book also talks about debt intolerance. What does that mean, particularly for emerging markets?
Right. Debt intolerance is this idea that many emerging economies seem to hit a wall, financially speaking, at levels of external debt that richer, more established economies handle just fine.
So a debt level that's manageable for, say, Germany might be crisis territory for another country.
Exactly. The safe threshold for debt isn't universal. It depends heavily on a country's track record, its history of default, its history of high inflation. These things create a kind of institutional fragility.
So past behavior really matters for future borrowing capacity.
Immensely. The book gives examples like Mexico in '82 or Argentina in 2001. They defaulted even though their debt to GDP ratios weren't necessarily astronomical by, say, European standards at the time. And here's another interesting point for you. They found that countries with weaker credit ratings, often because of past defaults, actually tend to borrow more relative to their ability to pay, especially relative to their exports, which is how they earn foreign currency.
That sounds like a recipe for trouble, a vicious cycle.
It can be, yeah. It's hard to break out of.
We talked about external versus domestic default. Looking across the whole historical period, how did their frequency compare?
It's interesting. While external defaults were more common before World War II, when you look at the entire 8 centuries they studied, there wasn't actually a statistically significant difference in how often governments defaulted on domestic versus foreign debt overall.
So domestic defaults were happening all along, just maybe less visibly.
Possibly. But there was a shift after World War II, especially with the move away from gold standards and towards fiat currencies, money not backed by a physical commodity.
Right. Governments could just print more money.
Exactly. And that made inflation a much easier, maybe more tempting way to deal with domestic debt burdens, effectively defaulting through currency debasement rather than an explicit announcement.
So using inflation to whittle away the value owed to your own citizens. But what were the consequences when they did default explicitly, domestically versus externally?
The book shows some pretty stark differences there. Around domestic defaults, the average inflation rate in the year of default was huge, like 170%.
Whoa.
Compare that to external defaults, where the average inflation was still high, around 33%, but much lower.
Big difference.
And the hit to the real economy, measured by GDP, also tended to be worse during domestic debt crises, more economic pain overall.
So an external default might get the international headlines, but a domestic one, especially combined with hyperinflation, could actually be more devastating for the people living in that country.
That seems to be the implication, yes.
Okay, shifting gears slightly. The book links the rise in banking crises, particularly since the 70s, to financial liberalization. Can you unpack that connection for our listener?
Yeah, they draw a pretty clear line. Since around the 1970s, we've seen this big global trend towards liberalizing financial markets and capital flows, fewer restrictions on money moving across borders.
Deregulation, globalization of finance.
Right. And while that has potential benefits, the book argues it also coincided with and likely contributed to an upswing in banking crises. They point to major global shocks during that period that put stress on banking systems.
Like what?
Things like the end of the Bretton Woods fixed exchange rate system, the massive oil price shocks in the 70s, the collapse in commodity prices later, and those very high U.S. interest rates in the early 80s that caused havoc for borrowers worldwide. Liberalization, perhaps, made systems more vulnerable to these shocks spreading.
It sounds like opening up the financial system also opened up new ways for crises to happen or spread. What about housing prices? I remember the book talking about that.
Oh, yes. Housing gets significant attention. They found a really strong historical link between massive run-ups in real housing prices and subsequent major banking crises.
Not just recently, but historically.
Historically, yes, across different countries, both advanced and emerging. And here's something really important for you. When housing busts follow these crises, they tend to be deep and long.
All long.
On average, they found real house prices fell by about 35%. And that decline played out over roughly 6 years.
6 years. That's much longer than a typical stock market crash recovery.
Exactly. Stock market crashes can be sharp, but often recover more quickly, like a V-shape. Housing downturns linked to financial crises tend to be much more prolonged, an L-shape almost, a long, slow grind downwards.
That's sobering, especially thinking about how central housing is to household wealth. Okay, this all leads inevitably to the 2007-2008 global financial crisis. How does the book fit that massive event into this long historical narrative?
Well, they see it as almost a textbook case, tragically. It was a powerful, painful reminder that severe financial crises weren't just relics of the past or problems for developing countries.
Right. It hit the core of the developed world.
Absolutely. And that this time is different thinking. It was rampant in the U.S., the U.K., elsewhere.
What were the arguments then?
Oh, Financial innovation had distributed risk effectively. Sophisticated new models could manage it. Central banks had mastered monetary policy. The Great Moderation meant stable growth was here to stay.
Sound familiar?
Exactly the kinds of arguments used time and again before crises throughout history. The book draws direct parallels between the U.S. pre-crisis boom and similar episodes in emerging markets, where authorities often get complacent, assume the good times will last forever, and fail to curb excesses.
It really does seem like a recurring human or maybe institutional blind spot. So when these big crises hit, how long do they typically last? What's the duration of the pain?
They stress that these are protracted events, not over in a quarter or two. We mentioned the housing market decline averaging 6 years.
Right.
Equity markets, on average, saw drops of about 56% over 3.5 years following major post-war crises.
Significant hits.
And crucially, government debt explodes. After severe banking crises, real government debt increases by an average of 86% within 3 years.
86% increase. Mostly bailouts and lost revenue, I assume?
Bailouts, stimulus, falling tax receipts due to the recession, yes, it all adds up incredibly quickly. And the hit to output, to people's livelihoods. Well, during the Great Depression, it took countries about 10 years on average for output per person to get back to where it was before the crisis.
A lost decade.
Pretty much. Post-World War II crises haven't typically lasted that long in terms of output recovery, but we're still often talking several years of stagnation or slow growth. Significant setbacks.
And does the global nature of finance today change things?
Absolutely. The book highlights that global crises are particularly nasty.
Why is that?
Because normally if one country or region has a downturn, maybe its exports can help pull it out, selling goods to countries that are still growing.
Yeah.
But in a synchronized global crisis,
Everyone's struggling.
right, exports collapse everywhere, trade dries up, asset prices fall in tandem across the world, there's no external demand cushion. That makes the downturn deeper and potentially longer for everyone.
It really underscores how interconnected and maybe fragile the system is. One last point I wanted to circle back to is data. You mentioned it was hard to get good historical data, especially on domestic debt.
Yes, and it's a point that authors really emphasize throughout. It's genuinely surprising how difficult it can be to assemble comprehensive, reliable, long-run data on public debt.
You'd think that would be basic information.
You would, but they suggest that sometimes the lack of transparency might even be deliberate, especially when governments are in financial trouble. Easier to obscure the true picture. They also note that even major institutions like the IMF haven't historically had a mandate to systematically collect and publish comprehensive public debt data across all countries over long periods. And there's this common belief that large internal government debt markets are a recent thing.
But the book says no.
The research shows that's just not true. Domestic debt has been significant and a source of crises for centuries. It's not a new phenomenon at all.
So even getting a clear picture of government borrowing has been a long-standing challenge. That definitely gives you, the listeners, something to chew on. Okay, let's try and synthesize this. If you were to boil it down, what are maybe 2 or 3 of the most crucial, perhaps surprising, takeaways for you from our deep dive into This Time is Different?
Okay, 3 things maybe. First, just how common sovereign default has been historically, even for the richest, most powerful nations. Financial solidity is not a given. It has to be maintained.
Right. History provides a dose of humility.
Definitely. Second, the critical and often underestimated importance of domestic debt and domestic defaults. They can be incredibly disruptive, sometimes more so than external ones, and ignoring them gives an incomplete picture of risk.
Look inside the country, not just outside.
Exactly. And third, the sheer persistence of the "this time is different" syndrome. That belief that we've overcome the old risks, that our boom is sustainable, it's seductive, it's pervasive, and history suggests it's usually wrong.
Be wary of the hype. Those are really powerful points. So maybe a final thought for you to consider. Given this long history of financial folly, what are the "this time is different" stories you're hearing today that deserve maybe an extra dose of skepticism? And thinking about those data challenges, when you hear discussions about government finances with questions about transparency, about the real debt picture, both domestic and external, should you perhaps be asking, understanding these patterns, this history that "this time is different" lays out so clearly. It really doesn't give you a crystal ball, but it equips you, the listener, with a much more critical, much more informed perspective to navigate the financial world. It helps you recognize the echoes of the past and the present.